Well, hello, everybody. What a crazy couple of weeks. Obviously, if you're just coming with us, I think last time we talked about possible effects of some of the wildfires. What is that going to do to our Southern California housing market? Well, we kind of have the beginning of some of those answers. We actually have some data to really put to some of the things that we're seeing empirically, or maybe that we're just kind of feeling out there in the marketplace. So much to talk about. I don't want to waste any more time. Let's get started. My name is Stephen Meade with Domicile Real Estate for people who love houses. And we're really going to talk about the Southern California housing market pretty much as a whole, but I'm going to try to focus on a couple things that I think are pretty important to be looking at right now. We just have kind of a lot of data out there. And we have one graph. This is not clickbait, but one of our graphs actually says you should absolutely drop everything and buy right now if you're sitting on the sidelines. That's what one graph says. Obviously, we try to take a little bit more of a holistic approach to everything and review all the data. But I want to start with that. And I'm going to do this out of order because I think this is incredibly important. So, those of you who have been watching for a while know that this is probably one of my favorite graphs in our portfolio. What this is this is a measurement of three things: relative payments on the median priced home, the CPI index, as well as a rent index. And uniquely, what we've done is we have zeroed all of these around June of 2018 and then shown how have they related to one another over time. And what I'm going to point out to you is that blue payment line as well as the yellow rent index have actually crossed over and inverted, meaning versus 2018, it is now cheaper to rent now, or cheaper to buy now than it is to rent relative to the way that relationship was in 2018. Now, if you look at this graph, you'll notice that that has not typically been the case. And in fact, it has almost always been more expensive to buy. And right now, you'll see that those have actually crossed over slightly. And that's really for two reasons. One, we're finally seeing some of the data that's come in on home sales, really honestly, towards the very end of last year or the beginning of this year. And guess what? Those prices were down. So that's why that blue line has fallen a bit. And then it doesn't really take a genius to figure out. You're probably reading in the newspapers or hearing about situations of price gouging. And even if people aren't gouging on the rents, right? Even if their asking prices are within the law, as you can imagine right now, there is a huge strain on immediately available rental housing, meaning something that people can get into immediately if they have been displaced. Now, typically after natural disasters, this is pretty common, right? The rental market sees a lot of havoc early on. In the short run, that kind of eventually stabilizes a little bit. And then you start to see the for sale housing market as that insurance settlement money starts to come in. You start to see that for sale market, usually a few months down the line, start to kind of have its own moment. So this is a bit of a unique time period, right? Because the rental market is going crazy. So if you're out there thinking, should I rent a place or should I buy one? This actually is that moment where really the scales have been completely tilted towards buying. So just take that into account and remember that a little bit. So we're going to go back through, we're going to go through kind of our beginning stuff. And if we look at our total active listings, we can start to see what's going on. So we actually have active listings as rising. I don't know how long this is going to last, but we're actually seeing a pretty strong beginning of the year in terms of amount of inventory that's coming into the marketplace. Most predictions have us up 10 to 15% in sales this year in terms of number of homes trading hands in California as a whole. I actually think we might do a little better than that here in Southern California. If we look at our new listings over the last 2 weeks, I mean, this really tells the story, right? We're above both under $1 million. That's great. But look at where we are versus $1 to $2 million versus last year. I mean, that's probably a 40% increase in new listings hitting the market versus where we were at this point last year. So really, it's showing there's just going to be a lot more homes available for people to buy, at least right now in the short term. Like I said, my prediction is that as that insurance settlement money comes into play, you're going to see that shift of craziness from the rental market over into the purchase market. So if you've thought about buying, it's obviously definitely a better situation, especially if you don't have a home to sell. You're really better off making that purchase probably in the beginning part of the year versus the latter part. If we look at our new escrows, that number has also jumped up, but again, it is not nearly as strong as it was last year. You'll see under $1 million. We're actually under in terms of that number of transactions, and we're just a little bit over on that 1 to 2 million. Now, what does that translate into when we look at our absorption rate? Now, admittedly, there's a lot of gyrations in this market, so I do expect in 2 weeks we're going to see kind of this normalize out a little bit. But I mean, we are really at about the 60% level for under a million and just over 50% for 1 to 2 million. That is not an immediate strong demand level, right? That says there are a lot more homes coming into the market than there are buyers who are scooping them up. So kind of something interesting to take a look at there. We look at our closed prices, right? This is going to explain why we're seeing what we're seeing. And also I want to give a little bit of context here. So remember, this data is 6 to 8 months old. This is not a measurement necessarily of exactly where negotiations are on homes today. But one thing that's kind of interesting is you see we had a pretty strong bump, even across all three of these price kind of tranches. You saw we had a price bump of homes that kind of sold in November, and then things go back down. But what's interesting is even though these look down, are these really that far off where we were, say, back in December? Not really. You know, we're kind of in that same ballpark, except here in this 25th percentile is definitely now. Now, is that a sign that we're facing kind of some fundamental affordability issues? And that's why those entry-level homes are still really suffering on that price front? That might be part of it. Like I said, I think the effect of these fires in the next couple of months is going to kind of wreak a little bit of havoc on the for sale market, just like it's doing in the rental market right now. But if we look at our percent still active after 14 days in the market, that number is starting to slip a little bit. And what does that tell us? That tells us that it's a market that might be tightening a little bit. So we might have had that sugar shot of everyone waiting into the new year to put those homes on the market, and that might be a little bit short-lived. So, you know, kind of temper some of your expectations there. If we look at our close to list ratio, that continues to sort of deteriorate, right? Like last couple of times we've been under 100%. I mean, now we're really almost towards that sort of like, you know, under 99%. We're really closer to like a 98 point something. And this is both under a million and 1 to 2 million. What does that mean? That long-standing tradition we've had where you just expected you were going to pay list price or more, it looks like that might be coming to an end, at least on average. There will still be homes that go over their list prices, but there will also be a good number of homes that go under. So definitely kind of bear that in mind with what we're seeing. This one, though, is kind of interesting, right? Days on market, we saw it creep up through November. And guess what? That has taken a dive. Now, what does this mean if inventory levels are rising, but days on market for new contracts is going down? It means that buyers are really favoring some of that newer inventory in the market, and they are not favoring those homes that are sitting. So this isn't average days on market overall for the homes. This is only for the homes that are actually finding buyers. And that's really a more important statistic because it tells us a little bit about which homes are finding buyers. And we're finding that it's buyers are looking at those newer homes that are coming online versus the older ones. Now, we've seen this graph already, so we won't go through it, that affordability of a median priced home. And then we look at our prevailing mortgage rates. The last few days have actually seen some improvement on this front. So we don't have the updated Freddie Mac sort of overall figure, but we are seeing some improved figures on this front. I think that's really going to help fuel some things for us. I noticed yesterday stock market dropped pretty significantly. A lot of times that leads to a rush to bonds, which lowers mortgage rates. We're just going to have to watch and see if that really is a trend. Obviously, politics, instability, all those things tend to push towards lower interest rates rather than higher. So we're seeing kind of a lot of government uncertainty going on. That's pretty much for this. And really just a lot of things going on at once. I wish I could tell you I knew exactly how some of these things were going to shake out. I think if anyone is offering that advice to you, they are taking guesses and they should qualify them as such. I do think we're going to see a market that tightens for buyers as the year goes on. I feel pretty confident in that. The hard numbers are that there are going to be a number of buyers that are looking for places to buy with money in their pocket in the next coming months. The typical stat is that about 30% of people who lose their home in a mass fire event like this choose not to rebuild themselves. They take that insurance money and they sell off their lot to a developer or investor who will then rebuild a house on that property. I think if we see that, I mean, that means we're going to suddenly see an influx, in this LA market area of, possibly four, maybe even 5,000 buyers out there that we didn't expect. That absolutely will be noticeable in our market. We're definitely going to see that, and those buyers are likely to have significant cash amounts coming into that, which might alter some of those market dynamics. Anyhow, that's all I've got for you. Questions and comments, as always, we love them. Don't forget to like, subscribe, and obviously, if you would like to borrow some of our expertise, we would love to provide it to you. If you're looking to buy or sell a home here in Southern California, let us help you. Don't be afraid to reach out. Contact information below. We'll see you again real soon.